Hi there, my name's Kelvin Davidson. I'm Chief Property Economist at CoreLogic, and over the next sort of 35 minutes, I'm going to run through a presentation that we give to anybody who will listen, really, just about the current context for the housing market, where it currently stands, where it might be headed. Obviously, always a lot of interest in what's going on with housing, and hopefully give you a bit of context on what we think about it and some of the bigger issues. I guess always two sides to the coin in the housing market at the moment. House prices falling, so first home buyers will be pretty pleased about that. But on the other hand, existing property owners would prefer that they'd probably stop falling, I suspect. So always different sides to it, and it's a useful sort of context to keep in mind. I'll just start by sharing my screen so you can see the slides. Okay, so for me, this slide really, I guess, gives away the game a little bit, but I think we're looking at a year of two halves. So yes, we're a few months into 2023 already. Things have remained pretty soft. I suspect they're going to stay that way for the next 3 to 6 months potentially. But once we get into the second half of this year, I think there's a case building for some slightly brighter times. Again, depending on your perspective, but I think towards the end of the year, I think we should expect the downturn to come to an end. So sales volumes may just start to improve a little bit and property values stop falling. So they might not start rising again for a little while, but at least stop falling. So for me, that's sort of what the second half of the year might hold: an improvement in sales and house prices finding their floor, but still some challenges to work through in the near term. So just a wee sort of agenda. The Reserve Bank is a key player in the property market at the moment, has been really since COVID first hit, with interest rate cuts, which pushed house prices up. Now interest rate increases, which has pushed house prices down. So the Reserve Bank still playing a pretty key role. Look quickly at what's been going on in the property market, around some of the key indicators. What credit conditions are looking like. Like I say, I think Reserve Bank's still a key player. Credit conditions are still a key driver of the market. And where to next? So just starting with that Reserve Bank perspective, the last official cash rate decision, which was a few weeks ago now, to be fair, but they went for only a 0.5% rise, which was a little bit smaller than what had perhaps previously been expected. There was an idea they might push up by 0.75. In the event, they only went for 0.5. At that time, Cyclone Gabrielle was obviously a huge factor and still is really. But at the time, they just felt it was still too early to judge what that might mean for inflation and the economy. So they decided to look through the effects of that and just push on with what they had previously said, which was, we still think inflation's a concern and we need to keep pushing up the official cash rate. So inflation is definitely still a concern. We've got the next official cash rate decision coming up in early April, so there's still a little bit of uncertainty about that. It looks like at the moment that the official cash rate will be pushed up again. Inflation is still definitely a concern for the Reserve Bank, but just this idea now that the peak for the official cash rate might not be 5.5% like was previously expected. We've had a weaker GDP number come through lately. We might already be in recession. Just some signs that inflation could, while still a concern, could still be at a peak, potentially starting to slow down, even if it's still quite high. So there's just a sense now that peak for the official cash rate might not need to be 5.5. Potentially it's 5% or 5.25. And of course, with that 5.5% peak for the official cash rate having been priced in to mortgage rates, there's a chance now that actually mortgage rates could start to just sneak down a little bit as people reassess where that official cash rate needs to go. But there's still concerns out there. We're in a recession. The unemployment rate's expected to rise. House prices are expected to fall further, as you can see on this chart on the right-hand side here from the Reserve Bank. They've got a projection that house prices will fall sort of in that range of 20%. They're down about 10% already, so a little bit to go yet. However, like I say, just the sense now that mortgage rates have peaked, depending on sort of what duration you look at and whether you're floating or fixed, but a sense that there's a generalised peak for mortgage rates having been reached. So that's sort of reassuring on one hand for mortgage holders that at least now they can sort of quantify their worst case. So yes, mortgage rate's still high, but at least this might be as bad as it gets. So it gives people some reassurance around their budgets. However, at the same time, I wouldn't be thinking that mortgage rates are about to collapse because, like I say, the Reserve Bank's still pretty concerned about inflation. I don't think they're going to be cutting the official cash rate anytime soon. So there is a sense that mortgage rates, even if they've stopped rising, won't suddenly start falling either. And yeah, still expensive to be a new borrower and tough for those existing borrowers who are repricing from a previously lower interest rate onto a higher one in the next sort of 3 to 6 months. So yeah, definitely Reserve Bank still in focus. I guess the key message here is that inflation is still an issue. We're going to see more official cash rate increases, but just that sense we're at a little bit of a tipping point where perhaps the original projection for the peak official cash rate might prove to be a little bit over the top. It might settle a bit lower than that peak. Okay, what about recent property performance? Sales volumes just exceptionally low at the moment. This chart here shows you calendar year total sales across the New Zealand residential property market. Less than 64,000 sales in 2022. You have to go back to 1983 to find a year where sales were lower than what they were in 2022. So we are running at very sort of subsistence levels, I suppose you'd call it in some ways. I think really the only people who will be selling properties and are doing so out of necessity at the moment, a job change, unfortunately maybe a death or a divorce, something like that, as opposed to just sort of testing the market. It's not a choice thing at the moment. I suspect it's mostly out of necessity. So rock bottom levels. The start to 2023, which isn't on this chart, but January, February sales activity has been just a continuation of this, very low. So pretty tough out there for real estate agents, not getting many listings in, not getting the sales through the door. So things are pretty quiet out there. When you see property sales at low levels, you tend to see property prices pretty weak as well. And of course, that's what we're seeing at the moment. So on our index on the left-hand side here, this is average property values around the main centres, definitely falling further. Auckland and Wellington, you can see there have had reasonably sharp falls in their property prices over the last sort of 12 to 18 months. But it's quite broad-based. It's across all of the main centres. Christchurch, if anything, has held up better. And that was what people had anticipated, that better affordability would hold up Christchurch house prices or keep them more resilient than what we might see elsewhere around the country. And so far, that's proved to be the case. We've had falls from the peak of 4 or 5% in Christchurch versus 20% in Wellington. So pretty different story depending on where you are. But the key thing is that the downturn is still quite broad-based. Even if the falls are smaller in some parts of the country than others, still falls. Just switching to the right-hand side here, this is breaking down national property values into sort of value bands, I guess you'd call it. So the upper quartile line there on the right-hand side is the top 25% of properties. The median's that middle reading for all properties, and the lower quartile is the bottom 25% by value. So you can see, tentative evidence here that the upper end of the market has suffered a little bit more, peak to trough, or from the peak so far. Values in that upper quartile down 11.5% as opposed to 6.8% at that lower end of the market. So some signs that the upper end's just feeling a bit more pain than the lower end, but I wouldn't sort of go overboard about this, really. It's the falls are across the board again, whether it's upper end or lower end, we have seen falls. So, but certainly one to keep an eye on, just a sense that the upper end might be doing a little bit worse, but certainly, nothing to go overboard yet, I don't think. Just looking quickly at listings. So what's going on in terms of that available property coming onto the market and then what's already on the market. What we're seeing lately is that new property listings, the weekly flow of listings is pretty subdued. So people aren't really listing. Would-be sellers are just sitting tight instead. I think there's uncertainty about, how long is it going to take me to sell? What sort of price am I going to get? I won't bother. I just won't list in the first place. Not really seeing many signs of investors selling off to any great degree either. So that new listings flow is pretty quiet. However, we've just seen that sales activity at the other end of the pipeline is pretty quiet too. So you don't have much stock coming on, but you also don't have much leaving either. So that means that the meat in the middle, if you like, the total stock on the market, total stock of property listed at any point in time, is still quite high. So a couple of charts here to illustrate that. On the left-hand side, we've got the national listings total, that sort of pink line there, 2023. This is how they evolve through each month, each year. So take that darker blue line there, 2021. That's how total listings moved through the months in 2021. Then you switch up to the purple line there, 2022. You can see that through last year, the total stock on the market progressively rose. And then 2023, that peachy line, it has kind of gone flat, but it's at a high level. So basically the stock coming on in terms of new listings has been offset, I guess, in some ways by the stock leaving at the other end of the pipeline through sales. Those two things have been low, but broadly offsetting each other. And that's left the total stock on the market at any point in time flat, but reasonably elevated. So you can see that peachy line there is above where it's been the last couple of years, and we're back to where we were in 2020. So there is decent choice out there for buyers. They know that if they've got credit, if they've got the finance, they've got choice on their side, pricing power on their side. So it is a buyer's market for sure. Just in Auckland, by contrast, a little bit tighter in Auckland. Not saying it's tight by any means, but tighter. It's not as in favour of buyers as it might be nationally in terms of listings. So you can see the peachy line there, 2023 has been flat again, and yes, it's higher than where it was in 2021, but below where it was in 2020 and below where it was this time last year. So, if anything, listings have risen in Auckland a bit, but not that much, and they're just sort of tracking sideways. So it's not so much in favour of buyers in Auckland as it is nationally, but we're still seeing prices fall. So I think you'd still probably call it a buyer's market. And what about some of these buyers? So this is our buyer classification series, which breaks down all of the transactions that are taking place in the market into buyer shares or market shares. So this isn't a number of purchases. This is percent share of purchases. So, for example, on the left-hand side here, we've got the national chart. This is our buyer classification, as I say. Key line here is that red line there, first-time buyers, 25% market share lately, which is pretty much as high as it's ever been. So first-time buyers, even though the number of deals is relatively low, within that quiet market, first-time buyers have been holding on to a pretty decent market share, as I say, sort of 25% nationally. So great for first-time buyers. It's been a falling market, so they've seen opportunities to make purchases using low deposit loans. That's one way in that people are finding that they can use that allowance at the banks to get in with a low deposit. I guess withdrawing KiwiSaver, that's been a factor. The bank of mum and dad, I guess a willingness to compromise on the property type. So, maybe looking at townhouses more than standalone dwellings. Compromise on location, potentially moving, out to the outskirts of an area into more sort of provincial markets, I guess, and then commuting back in. So these things have all been ways that first-home buyers have been getting in. By contrast, cash investors, I'll start with mortgaged investors, mortgaged multiple property owners. That's that lighter purple line there. In contrast to first-home buyers, really quiet at the moment. So 20% market share for mortgaged investors. Now, it's still 1 in every 5 deals is going to a mortgaged investor, but 20% is pretty low by their standards. So it's tough out there for investors to get those purchases to stack up. Like I said earlier, they're not really selling. Existing investors aren't really selling their portfolios, but they're finding it harder to expand or for a new investor to start a portfolio. So 20% is quite low, and no surprises. So you got to have 40% deposit. You are looking at a low rental yield when you buy. You're looking at a high mortgage rate. The cash top-ups to keep that property sustained will be quite large out of other income, so that's a deterrent. The tax system's changed. You've got higher compliance costs. Returns on other assets have gone up. You can get 5% in the bank now in term deposits, so there's less incentive, I guess, to look at property. Capital values falling, prices falling, so those capital gains that investors look for aren't there at the moment. So no surprises that their market share is low. However, cash investors, cash multiple property owners, that sort of darker blue line there, 15%. So actually, cash buyers are still seeing opportunities out there. Yes, they're still looking at low rental yields, but they don't need to worry about that tax deductibility so much because they're not paying interest anyway. They're not worried about higher mortgage costs. They're seeing opportunities. Yes, there's compliance costs and not much capital gain at the moment, but if they can get a good purchase price at the start, get a deal at the start, then it's probably going to pay off. So cash investors are definitely still seeing some value and then perhaps snapping up some bargains here and there. Just as an example of a regional level stat, I've got the Christchurch chart here on the right-hand side. And similar message. Christchurch has been a first-home buyers market for quite a while, and that's still the case now. 30% of transactions lately going to first-home buyers. So again, that affordability is still on Christchurch's side. There's a decent selection of stock, a range of stock available, and first-home buyers are finding ways into that Christchurch market. So interesting to see that. It broadly fits with the national picture, but even more so in Christchurch. Okay, so what about credit conditions? That's where the market's been. It's still pretty restrained. Some groups a little more active than others, but overall it's still quite quiet. I think for me, credit conditions is still a pretty big determinant of all of that. Now, this couple of things on this slide here. I mean, yes, mortgage rates I think have probably reached a generalised peak. If they haven't already, that peak will be pretty close. But we've still got this repricing wave that people really talk about, and this is still a bit of an issue this year. So on the left-hand side here, we've got the breakdown of all mortgages across the country, existing loans, and the sort of loan terms they're on. So that 49.6% there, sort of let's call it 50%, of all mortgages currently out there, 50% are fixed, but due to reprice within the next 12 months. So over the course of the next 12 months, the next year, 50% of current loans are fixed and will need to be repriced. So we've still got this wave of loans coming through. Now, 50% isn't an abnormally high number. If you look back through that chart, that darker blue line there is always sort of 40 or 50%. Go back a couple of years, it was a lot higher than that. That was when this sort of repricing issue really came to the fore, when that dark blue line there was up at 60 or 70%. But the banks have worked through that pretty successfully. Borrowers have worked through that pretty successfully. And we're back down to sort of a more normal level at the moment of 50%. However, it's still quite high. There's still a lot of people who face up to a repricing. And the key thing is that they're probably still going to be looking at a change in interest rates, an increase in their rate. So what might that be? Well, it's hard to know. The chart on the left-hand side, all we get from the Reserve Bank is when the loans are due to reprice. We don't know when they were taken out. So you can imagine somebody who's coming up to a repricing on a loan they took out 5 years ago will be looking at a different change in interest rates than somebody who took out a loan 1 year ago or 2 years ago. So it's hard to be sure about any of this. But as an example, if we look at the right-hand chart here, this is assuming you're somebody who's been on a series of 1 year fixes, which is probably what most people have been doing. What that change in interest rates might be. So you can see through 2020, 2021, their interest rates have fallen. So people who are repricing off a series of 1 year fixed rates saw their rate decline or fall each time. So, they were benefiting from that. However, then it got to the point sort of mid-2021 where interest rates started to go back up again, and that repricing involved an increase in interest rates. And you can see for the last little while there through most of 2022, people have been looking at a 2.5, 3 percentage point change in their mortgage rates. So they might have been going from those ultra low, let's say 2%, up to 4.5 or something like that. Soon, they'll have to reprice again. And so to the right of that dotted line on the right-hand chart, that's what the change might be as we progress through 2023. So, it's pretty typical over the rest of the year that somebody on a series of rolling 1 year fixes, they might have already repriced once. They've gone from 2 to 4.5, but they've got another repricing to come, and that could see them go to 6.5. So that's how that line that's what it's trying to show you, that as we progress through 2023, this is the change in interest rates that people might be looking at. So you can see it's still quite high. For most of the rest of this year, the change is still 2.5, 2 percentage points, that sort of thing. But once we get to the tail end of the year, that change is a bit smaller, 0.5% maybe, 1% maybe. So at the moment, people are going from low to high, and that's still a challenge for their household finances. But as we get towards the end of this year, people will be repricing from high to high, or even progressively from high to low. So there's still some challenges. This adds to my sense that the housing market is going to be restrained for a little bit to come yet. But get towards the end of the year, if mortgage rates have peaked and even starting to come down a little bit, this repricing has kind of fully worked its way through. People have fully adjusted to these new interest rates. Then I think that takes away one of the kind of handbrakes on the market. Just quickly on other things, wider lending rules are still relatively restrained as well. Their loan to value ratio rules are still pretty tight. the banks do have that allowance for low deposit finance outside the LVR rules, and that's pretty much all going to first home buyers. So that helps explain that relative strength of first home buyers. Interest only lending is still relatively controlled as well. The chart on the left here is the share of lending going out on interest only terms to investors in that solid purple line there, and to owner occupiers in the solid blue line. That's the flow of lending each month. So you can see within investor lending each month, there's still sort of 40% of lending does go out interest only. But if you look back sort of 3, 4, 5 years, that was much higher, 50 or 60%. So interest only lending has come down. It's come down for investors, it's come down for owner occupiers. And then the dotted lines there are the existing stock of loans. How many outstanding loans are on interest only terms? And of course, if the flow has been going down, the stock will come down over time as well. So that's why those dotted lines have been trending lower. So there's interest only lending is relatively controlled. Non-performing loans at the banks are very low. We're not seeing mortgagee sales. So the previous slide talking about that refinancing wave and how there was a lot to do kind of a couple of years back. Like I said on that slide, it's been managed pretty well. This process is kind of working its way through. We haven't seen a big rise in non-performing loans or mortgagee sales. Yes, people's finances have had to be adjusted, but so far the process has been managed pretty well. Just one thing to point out though, on the right-hand side here, this chart, the banks have been putting bigger provisions on their balance sheets for potential bad debts. So this is collective provisions for bad housing loans on the right-hand side here. You can see that has been going up in recent months. So just something to be aware of. The banks are preparing for it. The scale of this, 700-800 million is pretty tiny in the scale of things. The total stock of outstanding mortgages across the country is worth about 350 billion, something like that. So 700 or 800 million is pretty small. But just it's the direction of travel that's the interesting thing, and it's starting to creep up a bit. So I guess banks are preparing for it, but they're not preparing for a wave of bad loans. So again, the process has been managed pretty well so far, and I think the expectation is that it kind of stays that way. But yes, some challenges for households in terms of their budgets. Okay, so just to kind of bring it all together, I think there's definitely near-term challenges for the housing market, no doubt about that. But late 2023 could start to look a little bit better from that perspective of sales activity improving and house prices stopping falling, which, like I said earlier, would be first home buyers would actually prefer they kept on falling, but different perspectives there. Part of the challenge, I think, for the housing market, not only in the next year, but the next 5 years, the next 10 years, is that housing affordability is still a big problem. So, even if I'm right that house prices find a floor at the end of this year, maybe they start to rise a little bit again in 2024. I don't think the growth is going to be very strong at all, because we've still got stretched housing affordability. And so these measures, take a look at this. On the left-hand side here, we've got national measures. The value to income ratio in that sort of lighter purple color, that has improved. Yes, as house prices have gone down and incomes have gone up, that ratio has fallen, which is an improvement in housing affordability as that ratio gets lower. But look where it started. It was at an extremely high level, sort of late 2021, early 2022. And yes, it's come down a bit, but the improvement's been pretty small and from a stretched position. So, there's still a lot more work to do on housing affordability. When you look at mortgage payments as a percentage of income, that's the dark blue line there. That's actually got a little bit worse in the last few months so yes, house prices have gone down, incomes have gone up, but so have mortgage rates. So that measure is actually the cash that people are paying as a share of income has actually just got a little bit worse lately. So housing affordability is still a big challenge for the market, and I think it does restrain. It's a long run handbrake. Even if the market does reach a floor this year and start to rise again next year, it's not going to be off to the races again. Affordability is still really stretched, so that 5 or 10 year horizon for affordability it's going to restrain house price growth, and it signals that we need more housing. Perhaps we need different types of housing, more intensified use of land. A sort of a housing stock that allows more access for different buyers. So some challenges there, things to be worked through. But switching to the main centres on the right hand side, just to illustrate the position around the country. Again, it's pretty similar messages. So this is the mortgage payments as a percentage of income in each of the main centres. And I wouldn't necessarily look at the levels per se. I mean, you look at Tauranga and see that at 60-70%, that looks pretty stretched. I think it's important to look at Tauranga relative to its own history and relative to sort of the other markets. So it's more about that. It's saying, okay, Tauranga is, it's pretty stretched compared with its own past, and it's stretched compared with other parts of the country. So it is still quite an expensive market. But all of the main centres have seen a decline in housing affordability on this measure. Each of these lines has gone up, which is worse for housing affordability, and has seen a very little improvement lately. So yes, definitely still some challenges on housing affordability. That's a long run handbrake for growth. I guess trying to build that case for the floor for the market towards the end of the year, we're going to see the unemployment rate rise, I think, and that's going to probably potentially take over in terms of householders' minds about sort of issue number one. Up until recently, it's been higher mortgage rates is kind of concern number one. I wonder if rising unemployment soon takes over as issue number one. But also important to point out that even if we do see the unemployment rate go up, which is what the Reserve Bank's projecting, it's starting from a very low level, which is what I'm showing in this chart here. It's currently running 3.2%, 3.3%, so very, very low. And there's a bit of a distinction to make here. So the Reserve Bank is projecting that the unemployment rate rises, but it's mostly due to new people coming into the labour force, so new migrants to the country, people coming back from a break, raising kids, coming back into the workforce, these types of things. Wages are high, so people are drawn into the labour force, but just at the time when perhaps job creation by businesses slows down. So those people coming into the labour force find it harder to get work, and so they get recorded as unemployed, as opposed to job losses. I think people who are already in work will largely hang on to their jobs. So it's not about job losses, it's about unemployment rising due to new people coming into the labour force and finding it harder to get work. Businesses will want to protect their existing employees at all costs, really, given skill shortages and these sorts of things. So if people are in work, they're probably going to keep their job, they're probably going to keep their income, and they'll keep servicing that mortgage. So there could be a sort of two-speed thing here where people who are in existing work, have an existing mortgage, yes, they're going to have to adjust their finances, but will have a degree of insulation, I suppose, in terms of protection against, mortgagee sales, this types of thing. But new people coming in will find it harder to get a job and perhaps won't be able to borrow as readily. So a wee bit of a two-speed thing there. And I think it does just soften, when you see headlines about the unemployment rate rising, it's quite striking, it's quite concerning. But just that nuance there, that it might not necessarily be about job losses. More due to a potentially bigger labour force. So that, to me, that sort of does lend a little bit of support to the housing market as well. So first point is you've got mortgage rates peaked, maybe starting to come down again. You've got unemployment rate not necessarily going up due to job losses. People in work keeping their job will tend to have a degree of insulation. So mortgage rates creep down a bit, people stay in work. Those are a couple of factors arguing for the downturn in housing to come to an end. And then the third thing to add to that list is net migration. So we've seen net migration really turn around sharply in the last 6 months. We've really seen it turn around, and this is illustrated on this chart here. The annual net migration flow, which was negative sort of this time last year, is now firmly back into the positive. So I think I wouldn't overstate its near-term role. I think there's still restraints here from credit conditions. I think that's been the key factor. But fundamentally, you've got more people in the country now, net migration's up, more people wanting to live somewhere. That adds to property demand, whether it's for rent or to buy, and that puts a floor under the market too. So this is sort of factor number 3, just in starting to build that sense of the end of the downturn coming into sight. You see net migration turning around, and that adds to that list. So this is definitely one to keep an eye on. It could, I suspect, a lot of new migrants to the country will probably go into rental accommodation first, while they suss things out, figure out where they want to live, what job they might have. So it could show up through rents more than property prices, but eventually it's still property demand. It still kind of puts a floor under the market. So those are, as I say, those are sort of 1 or 2 or 3 pretty key fundamentals. I think you can also add in there a mindset shift potentially. Now, this is very hard to quantify and very sort of a bit abstract, but we know psychology plays a role in the housing market. We know the mindset plays a role, And by the end of this year, the downturn will have been in progress for a couple of years. It'll be quite deep and long by then. Just this idea that at some point the mindset shifts around. People think, you know what, there's probably some value out there again. I'm going to start buying, and very hard to know when that happens. It can turn on a dime, so to speak. But just that mindset shift, I'm wary of towards the end of the year as well. And then property investors. We've got an election coming up, national. If they won, which no guarantees. Who knows what's going to happen in politics? But if they won, National was firmly pledged again that they'll reverse those tax deductibility changes for investors. So if the polls are starting to show a potential win for National, well, I think some investors could try and get ahead of that and start saying, yep, I'm going to get my tax benefit back. I'm going to go buy property again. So, and potentially if they buy this year, they'll get ahead of debt to income ratio caps, which I think are coming for new mortgages next year. So, and they will tend to hit investors harder than owner occupiers. So for me, there's a chance that investors start to come back towards the end of the year as well, and that just adds the sense of the downturn finally bottoming out towards the end of 2023. So this slide kind of summarizes all of that. I mean, we'll see low sales for a little bit yet, prices to fall further, but those things to flatten out as we get to the end of the year. Talked about mortgage rates peaking. People can potentially quantify their worst case now, rising net migration, investors trying to preempt the election. I suppose in terms of regional considerations, we have seen Auckland and Wellington fall pretty sharply and fall earliest. So, what goes up must come down. I suppose what goes down might go up. And, it could be that actually those markets that have fallen first and fallen fastest could then reach the floor quickest and start to recover a bit quicker than elsewhere as well. So one thing to keep an eye on. But again, longer term, there's still some big issues here. We've still got housing affordability as a problem. Even if things bottom out this year, it's not going to be boom times again in 2024. We're still going to have stretched affordability. The government's looking at land reform, so we're opening up new supply for housing. And the tax system just seems to be on average more weighted against property than it used to be. So I think there's some longer term restraints on the market. We've still got challenges. We need to really think about, I guess, the houses we build, especially in light of Cyclone Gabrielle, the houses we build, the types of properties, where we build them, these types of things, and what best caters to the, I guess, societal changes, the way that people want to live. Do they want a big lawn anymore? These types of things. What types of properties are they more interested in? Things that are healthier and more sustainable and warmer, well insulated. These types of things, well designed with access to public amenities and these types of things. We're seeing build to rent come onto the horizon a little bit. Do people actually want access to a gym and public spaces? These types of things, like we see overseas. So, yep, definitely some longer term issues there. Near term, hopefully I've given you a good steer on what we think about the housing market at the moment. Is it a good time to buy? Well, I think, if you're a first time buyer out there, depends on your situation, of course. I always think that it has to be hopefully more about just the financial side of it. Yes, it matters, but the non-financial side matters too. And, you might like a house, you might like a location, you want to establish that base. If that was me, I'd probably just buy, because it's about more than just those financial considerations. And of course, you never know what's going to happen to mortgage rates later. You never know what's going to happen to credit conditions. Yes, you might wait and get a cheaper house price, but you might miss out on a house you really like. So there's definitely considerations out there. There seems to be a decent selection of stock at the moment. And ultimately, for me, not financial advice here by any means, down to the individual, but I think when you're buying for the long term, you want to live there 20-30 years, then it's got to be about more than just those financial things. All right, so I think that's really it from me. Just to say thank you, and we normally have a Q&A, not going to be as readily as much of an option on this particular format, but just to say thanks for taking the time to watch, and tune into our podcast there if you get a chance. So thanks for listening, and all the best in your property decisions.